Welcome back, everybody. This is the third and final discussion video for Chapter 13, and we're starting with Learning Objective 5 here, determine the most profitable use of a constrained resource. So companies are very commonly forced to make some kind of volume trade-off decisions when they don't have enough capacity to produce all the products and sales volumes demanded by customers. So a lot of companies make a lot of different things these days, and it's not feasible for them to fill full capacity on every single product. That's been especially true lately with constraints in the supply chain, but we're talking about something a little different here. So in these situations, regardless, companies must trade off or sacrifice production of some products in favor of others, and typically we want to do that in a way that maximizes profits. We want to focus on producing and selling the thing that can generate the most profit. Now, when we have some kind of limited resource that restricts our ability to satisfy demand across our products in some way, we're said to have a constraint. And the machine or process or material or whatever that's limiting that overall output is referred to as the bottleneck. If you picture a bottle, we're talking about the neck of it where bigger flow gets to smaller flow. Same deal here. It's whatever's holding up that production in that way. So typically fixed costs in these situations are unaffected by whatever we pick to focus on making. So the product mix that maximizes total contribution margin is the one that should be selected. So we want to focus on whatever makes the most profitable use of the constrained resource first, not necessarily what has the highest contribution margin per unit of product. Sometimes those things are not one and the same. So we're going to focus on whatever maximizes the profitability of the use of these constrained resources. Let's look at an example. Let's say that Ensign Company makes two products, and here's some data related to them. The first sells for $60 and has a CM per unit of $24. The second sells for $50 and has a CM per unit of $15. Now the current demand per week is 2,000 units of each. The first, as we note from the data above, has a 40% CM ratio. Second has a 30% CM ratio. And they differ in the processing time they require on this machine A1. Product 1 takes a minute per unit on that machine. Product 2 just takes half a minute on that same machine. So let's assume that that machine is the constrained resource or the bottleneck in the process, and it's being used at full capacity. Let's say there's excess capacity though on all other machines. So this is the true bottleneck. Machine A1, let's assume it has a capacity of 2,400 minutes per week. So the question is, should Ensign focus its efforts on product 1 or product 2? So the key then is which product generates higher CM per unit of that constrained resource. In this case, per minute of that processing time on A1. Now, product 1 generated CM per unit of $24, but took a full minute to process each unit on A1, so its CM per minute is $24. Product 2 generated CM of $15 per unit, but took just a half a minute to process, so it can generate $30 in CM per minute. So all else equal, we'd say that Ensign should emphasize product 2. We should spend all the time we can making and selling product 2, because it generates CM of $30 per minute of this constrained resource versus $24 per minute for product 1. So we'll fill all the demand for product 2 first, and then if we have time left over, we'd want to make and sell product 1. And let's see how that looks for Ensign here. So the weekly demand for product 2 was 2,200 units. We're going to fill all of that. So time required per unit was half a minute. So total time spent making product 2 then would be 2,200 times 0.5 or 1,100 minutes. We would then have 1,300 minutes of processing time on A1 left to make product 1. That's the total time available on the machine, 2,400 minutes a week, minus the 1,100 we would burn up making product 2. We'd be left with 1,300 minutes to make product 1. And in that time, we could make 1,300 units of product 1. So there's the optimal mix for Ensign here. Going to make 2,200 units of product 2 and 1,300 units of product 1. That'll maximize profitability given this constrained resource of this processing time on machine A1. And here's the dollars associated with that. So product one, 1,300 units times the $24 CM per unit, total CM of 31 and change. Product two, we were doing the 2,200 units. They're generating the $15 in CM per unit. So there's total CM of 33,000. Total CM at this optimal point for Ensign, 64,200, the sum of those two. Let's try another one then. The Wester Corp here produces 3 products with the following cost and selling prices. So we're showing that for products 1, 2, and 3. The company has insufficient capacity to fulfill all the demand for these 3 products. If machine hours are the constraint, then the ranking of the products from the most profitable to the least profitable use of the constrained resource is what? So pause this, work through that, and then come back and check your solution. So the answer there is D. So machine hours are the constraint. So we want to find the contribution margin per machine hour that each product generates. For product one, their CM is $21 minus $11, or $10, divided by 0.2 machine hours per unit, or $50 in CM per machine hour. For product two, that's a CM of 12 minus 7, or $5, divided by the 0.5 hours per unit needed, or $10 in CM per hour. And then product three was a CM of 32 minus 18, or $14, divided by the 0.2 hours it takes to make each one, for a CM per hour of $70. So we'd want to first make and sell as many of product three as we can. Then with whatever's left, we'll focus on product one. And if there's still time left after we're done filling that demand, then we'd make some product twos and sell those. And that brings us to learning objective 6, closely related. We want to determine the value of obtaining more of the constrained resource. So increasing the capacity of any of these constrained resources should lead to increased production and sales and profits. So the question becomes, how much should Ensign be willing to pay for an additional minute of machine A1 time from our previous example with Ensign? Now in Ensign's case, the additional machine time would have to be used to make more units of product 1, because the demand for product 2 was already completely filled. And that product had a CM per minute of $24. So all else equal, Ensign should be willing to pay up to $24 per minute for additional processing time on that machine A1. So maybe we can outsource processing. Maybe we can potentially secure a rental or some kind of other situation where we're increasing capacity. Bottom line is they should be willing to pay up to $24 per minute for that, because we would be making and selling this additional units of product 1. Now, it's often possible for managers to increase the capacity of bottlenecks or release these bottlenecks in several ways, including the following. First, potentially working overtime on the bottleneck. So if it's machine time, maybe that's less applicable. But if our constraint is some kind of labor resource, maybe we can have people work extra. We may be able to subcontract some of the processing that would be done or outsource it, as I mentioned earlier. We may be able to invest in additional machines at the bottleneck. So if capacity is really this constrained by one particular process, we may need to double up the process. We may be able to shift workers from non-bottleneck processes to the bottleneck. We may be able to focus business process improvement efforts on the bottleneck. So maybe the constraint is also constrained, if you will, by inefficiencies. Maybe we have some areas to improve in terms of what's happening at the bottleneck. That can buy us some more time or some more resources at the bottleneck. And then finally, reducing defective units processed through the bottleneck. If we have to do any kind of rework or any kind of thing by pitching defective units and making them again, or adding to them, or changing them, or doing something else, we're kind of wasting this valuable constrained resource. So reducing defects there could certainly help us relax that constraint. And that brings us to our final learning objective, number 7, which is to prepare an analysis showing whether joint products should be sold at this split-off point or processed further. So in several industries, 2 or more products known as joint products are produced or come from a single raw material input. And the first example I always think of, and we use it in the text as well, is crude oil. A lot of things come from crude oil, right? Gas, chemicals, and so on. So the point in the manufacturing process where joint products can be recognized as separate things is called this split-off point. And the decision is whether to sell at the split off point or to process further into something else is known as a sell or process further decision. And again, for us, we're going to focus on maximizing potential profitability with these decisions. So as I mentioned, the first example that tends to come to mind is petroleum refining. So we've got a single input there, a common production process, and then at split off, we can turn that stuff into oil, gas, chemicals, and so on. Now, and as we'll talk about, we have some joint costs that are typically incurred up to the split off point as part of those common production processes. And those are going to be considered sunk costs with regard to the sell or process further at split off decisions because they're happening before that split off point. So here with refineries, we can have oil, some separate processing, turning that into something else for a final sale. Gas, maybe we're selling at split off as gas. Chemicals, maybe we're doing some extra processing again and selling that as something else down the line with some separate product cost to do that processing. As I alluded to a minute ago, joint costs are traditionally allocated among different products at split off, but a typical approach is to allocate according to relative sales value of the end products. Again, these aren't going to be relevant though for that sell or process further decision. In addition, allocations like this are pretty dangerous for decision making because we're kind of under that same scenario we've talked about this semester where we're treating them as if someone has to cover them when really we're not kind of assigning them in a way that represents how those different products consume resources differently. Now, for purposes of these decisions of whether to sell or process further, we're going to stick to whether we can maximize profitability by, choosing one versus the other. So the point for us will be, are the incremental revenues from extra processing greater than the incremental cost of doing that processing? Let's take an example then. Let's say Sawmill Inc. here cuts logs from which unfinished lumber and sawdust are the immediate joint products. The unfinished lumber is sold as is or processed further into finished lumber. The sawdust can be sold as is to gardening wholesalers or processed further into Presto logs, these fire starters. Let's assume the following data about Sawmill's joint products here. The lumber sales value at split off is $140 per log. Sawdust is $40. The sales value after some further processing would be finished lumber $270, the Presto logs $50. The allocated joint product costs are $176 and $24 respectively for the lumber and sawdust. And the cost of the further processing after the split off there, $50 for the lumber, $20 for the sawdust. So here's our analysis of whether we want to sell this stuff at split off or process further. Let's take the lumber first. The final sales value after turning it from unfinished to finished lumber is $270 per log. We'll subtract from that the sales value at split off, so the unfinished lumber of $140, and our incremental revenue from that additional processing is $130 per log. Now subtracting from that the cost of doing the processing of $50 means we're at an $80 financial advantage per log of doing that processing. So of turning the unfinished lumber into the finished lumber. So we'd say that this lumber, we want to sell it as finished lumber to the extent we can. It's more profitable to do so. Now the sawdust, on the other hand, had a final sales value for the Presto logs of $50 a log, minus the sales value at split off of the raw sawdust, $40, is incremental revenue of just $10 per log. Now if we subtract from that the cost of doing the extra processing to turn it from sawdust into the Presto logs of $20, that means we have a financial disadvantage of doing that extra processing of $10 per log. So all else equal, we do not want to turn the raw sawdust into the Presto logs. We want to just sell it as raw sawdust at that split off point. Now, making a connection back to our Chapter 7 material, activity-based costing can be used to help identify some potentially relevant costs for decision-making purposes. But managers really need to be careful here and caution against reading more into this traceability than really exists. So there is a pretty natural tendency to assume that if a cost is traceable, that it's automatically avoidable, which is not true. We cannot unequivocally say that traceable costs are avoidable. So before making a decision, we have to figure out which of the potentially relevant costs are actually avoidable. So just a closing caveat there, from something for us to make sure we're aware of. And with that, that wraps up the last discussion piece here for Chapter 13. Back up and review any piece you need, and then move on to the practice problem video.